You've probably seen the headlines by now. Oil to 200, energy shock incoming. The Orinoco choke point nobody's pricing. Some channels are already speaking in certainties, timelines, and inevitabilities. That's not what we do here. On this channel, Financial Briefing, the goal is clarity over excitement, probability over prediction, and context over clicks. Today, I want to slow this conversation down, walk through the actual data behind the Orinoco blockade narrative, and separate what is genuinely underappreciated risk from what is already being exaggerated. By the end of this video, you should have a clear framework for how oil could spike hard, and why it might not, and what I'm personally doing with that information right now. Before we get into the numbers, I want to do something we always do here, which is look backward before looking forward. In March, when several commentators were calling for an immediate breakout above $95 on Middle East escalation, we said the more likely outcome was a range between 78 and 90, driven by inventory normalization. That's exactly where we traded for the next 8 weeks. In early June, when recession narratives picked up again, we argued that crude demand destruction was being overstated and that sub-80 prices would probably be brief. WTI dipped to 76 and reversed within days. And last fall, we said that strategic petroleum reserve refilling would put a floor under prices near 70, not push them to 100. That call was roughly right, and the accountability matters because today's topic is far more emotionally charged than those were. So let's talk about the actual data driving this conversation. The first data point is Venezuelan heavy crude exports moving through the Orinoco belt. Right now, Venezuela is producing roughly 800,000 barrels per day, up from the lows of 600,000 2 years ago. About 60% of that comes from the Orinoco region, and nearly all of it requires blending and specialized transport routes. Historically, when Orinoco output has been disrupted, the market impact has been asymmetric. In 2019, when U.S. sanctions restricted flows, global supply dropped by about 500,000 barrels per day. Prices didn't immediately spike, but heavy sour differentials blew out, and refiners scrambled. What this means is that Orinoco disruptions don't always show up cleanly in headline Brent prices right away. What it does not mean is that a single blockade automatically removes millions of barrels overnight. Capacity, storage, and rerouting all matter. The second data point is global spare capacity. According to the most recent IEA estimates, effective spare capacity sits around 3.5 million barrels per day, almost all of it concentrated in Saudi Arabia and the UAE. Historically, when spare capacity drops below 2 million barrels per day, oil markets become extremely sensitive to shocks. In 2008, spare capacity was under 2 million, and prices surged to $147. Today, we're not there yet. What this means is that there's still a buffer, but it's geographically and politically constrained. What it does not mean is that spare capacity is immediately deployable without consequences or time lags. Markets often overestimate how quickly that oil can actually reach refineries. The third data point is global inventories. OECD commercial inventories are currently about 200 million barrels below the 5-year average. That sounds dramatic, and it is, historically tight. In 2022, when inventories were at similar deficits, Brent averaged just over $100 for several months. What this means is that the system has less shock absorption than usual. What it does not mean is that inventories alone dictate price spikes to 200. Demand elasticity, substitution, and policy responses still play a role. Now let's talk through the bullish case calmly and methodically. First, a prolonged disruption in Orinoco heavy crude would disproportionately affect complex refiners, especially in the Gulf Coast, forcing them into higher cost alternatives. Second, if spare capacity remains politically constrained or slow to respond, the market could reprice risk rapidly, not linearly. Third, inventories starting from a deficit position amplify any supply shock. And fourth, financial positioning is relatively light, meaning there is room for speculative inflows if momentum builds. Put together, there's a credible scenario where oil overshoots fundamentals temporarily. I assign roughly a 25% probability to a spike toward the 150 to 200 range within the next 12 months, driven more by fear and positioning than sustained scarcity. Now, the bear case. First, the Orinoco narrative assumes a clean, total blockade. Historically, disruptions are messy, partial, and leaky. Second, high prices themselves are self-correcting. Demand destruction accelerates above $120, particularly in emerging markets. Third, political pressure to release strategic reserves increases dramatically in a spike scenario. And fourth, global growth indicators are mixed at best, limiting sustained demand growth. This scenario, where prices spike briefly and then fade back below 100, carries about a 30% probability in my view. Which brings us to the middle case, the one I think is most likely. In this scenario, Orinoco disruptions create regional tightness. Heavy crude differentials widen, and Brent trades higher, but within a range. Think $110 to $130, volatile, headline-driven, but not a runaway move. Supply responds slowly, demand softens modestly, and the market spends months digesting the shock. I put this outcome at roughly 45% probability. It's not dramatic enough for thumbnails, but it's how commodity markets usually behave. To understand why, it helps to look at history. The closest parallel here is probably the 1973 oil embargo. Then, a geopolitical shock intersected with limited spare capacity and rising demand. Prices quadrupled. The similarity is the structural tightness and political leverage. The difference is flexibility. Today's energy system has more substitutes, more transparency, and faster policy responses. We also have financialized markets that overshoot and correct faster. History doesn't repeat, but it rhymes, and this rhyme is quieter than the headlines suggest. Cross-market signals matter here. Gold is trading around $32, silver equivalent. Terms: holding strength but not breaking out violently. That suggests hedging, not panic. The dollar index remains range-bound, which argues against a sustained commodity superspike. The 10-year yield is elevated but stable, signaling inflation concern without loss of control. Together, these markets are saying risk, not crisis. Positioning data backs that up. COT reports show managed money net length in crude is below the 5-year average. Banks are cautious, not aggressively long. Institutional flows suggest optionality, not conviction. That's important, because true blow-off moves usually require crowded positioning. We're not there yet. So here's my action plan, and this is not advice, just my framework. If oil breaks and holds above 115 on volume with inventory draws accelerating, I add modest energy exposure, taking my allocation from 8% to 12%. If prices spike above 150 quickly, I trim into strength. My current allocation is 8% energy equities, 5% precious metals, 60% cash and short duration bonds, and the rest diversified. My stop loss on new energy positions sits 15% below entry. My take profit zone begins above 140. Again, not advice, just my plan. What I'm not doing is just as important. I'm not panic buying oil futures on headlines. I'm not doom scrolling fear content that treats probability as certainty. And I'm not assuming systemic collapse from a single choke point. My watch list this week is simple. First, Venezuelan export data. Sustained declines below 600,000 barrels per day would be bullish. Stabilization would be bearish. Second, Saudi spare capacity signaling. Any concrete timeline for increased output caps upside. Third, inventory reports. Draws above 5 million barrels weekly would confirm tightness. Builds would undermine the narrative. Let's wrap this up. 4 takeaways. 1, the Orinoco risk is real but nuanced. 2, $200 oil is possible but not probable. 3, most signals point to volatility, not catastrophe. And 4, disciplined frameworks beat emotional reactions every time. If you value calm, data-driven analysis without the noise, subscribe to Financial Briefing. That's it for today. Stay sharp.